Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Everybody talks about the boom in the real estate sector. It can't happen without an uptick in the sale of the core commodity, which is flats. And that can't happen without financing. So if indeed the real estate cycle is alive and kicking and here to stay, it pays to try and understand what could happen to the lending space as well, which of course has been, it has had its own share of pluses and fluxes, so to say. The good part is that we're starting to see, or we have seen, at least starting Q1 FY23, some fairly strong performances by select lenders. One such name is Canfin Homes. They recorded a 49% growth in YOY PAT, a beat of about 7% PPOP compared to most street estimates. And lots to talk about with Mr. Girish Kousgi. He joins us right now on the show. Mr. Kousgi, good having you. Thanks for joining in. What's your sense about the overall environment? Because, I kind of call FY23 as the first normal year in the last 3. What's your sense about how things are shaping up? How do you analyze the landscape?
Good morning, Neeraj. I think thanks for having me here. If you look at after COVID, after we lost about 2 quarters, the entire industry lost about 2 quarters. And from October, the demand was back. And there was revival in the real estate space. So 2020-21 Q3 onwards, to be specific, October onwards, demand was quite robust. I think most of the companies did their all-time high in Q4. And since then, I think no looking back, but for last year, Q1, because of COVID second wave. So in terms of affordability, it is quite low. Real estate prices are quite low, even though there is increase in construction cost, about 11-12%. Since demand is so robust that I think these kind of small deterrents will be easily taken care of. And last year was a good year for the entire industry, in spite of Q1 being muted because of COVID second wave. Last year was pretty good because most of the companies and the industry did well for the balance 3 quarters. And this quarter would be far better than last year. This year will be far better than last year. In that sense, I think really this space has caught up and we are in a sweet spot. Yes, rates are going up. Construction cost has gone up. In spite of these 2 small deterrents, I think the industry will do pretty well. And same thing is true for Canfin.
Actually, I was going to ask you that at maybe amongst the first questions, in line of the fact that houses have become more expensive. There might be a drop in the area size, so the ticket sizes may not have changed as much, but houses are more expensive square foot per se. And the fact that lending rates also are moving up. The jury split. Some people say on such a large base, 100 basis points or 125 basis points rate hike will not make too much of a difference, and some people say it would. What's your sense, sir?
Actually, during COVID time, the flat size and the house size have increased because of work from home culture.
Sure.
And we've seen a lot of people moving back to their hometowns and trying to build homes there. So area has actually increased, not decreased. Number 2, we have seen interest rates, at 12-13%, maybe a few years back. And even just before COVID, I think a lot of companies were operating at a yield of 9-10%. So I think increase in interest rate by 125 to 150 bips, I think it's more to do with psychology. It's only a mindset. I think over a period of time, maybe a quarter or 2, post the rate increase, I think people will get used to, because this is not something new. We are seeing this happening for the last 3 decades. Rates go up and go down. And whenever it happens, there is an impact, and that is short-lived. So I don't think so. Increase in rate, we're not seeing that. In spite of rate increase, a lot of companies have done well. So this will continue. Rates will further go up, and demand will be quite robust. There might be some impact, but that will be negligible. And therefore, increase in interest rate, I don't think so, will not really impact the industry.
Okay, just a small disclaimer from my end. When I said that the sizes have gone down, what I meant was when I speak to players like Brigade Enterprises, for example, they say that if the flat was getting sold at 1.5 crores, they are still maintaining the ticket price. What they are doing is that the quantum of area given in that flat of 1.5 crores has been pulled down a little bit because of increase in cost. So they are not tinkering with the ticket size, which is what I was trying to say.
Okay.
Yeah. Just a follow up though, Mr. Kousgi, to what you mentioned. I heard you mention that, I mean, it was a COVID phenomenon that people moved back to their hometowns. Now people are essentially getting back to the workplaces. But my question to you is, have you sensed that the surge that you may have seen in non-metro or tier 2, tier 3 cities / towns during COVID, is that still continuing?
I think the trend between small towns and big cities, see, for us, it is 50-50. So we do 50% of business from, large cities. I might say, let's say top 10 cities. And the next, 30-40, we do another 35 to 40, and the balance in the rest of the towns. So for us, it is actually 50-50 in terms of business contribution. Now, this trend has not really changed. And even if it changes, it will be 2% plus minus, not majorly, because our focus is on all the cities, more so in terms of tier 2 and 3. In large cities, we focus on the outskirts. So because that's where our pocket is. So we don't see much of a difference in the mix.
There is always a talk of what could happen to select asset quality or liability franchisees, and how the outcome would be, or what are the risks to those kind of particular books. In some sense, your asset quality outcomes kind of, would you reckon, Mr. Kousgi, negates or refutes the skepticism that may be there? How would you think of addressing that?
See, we are part of the industry, part of system, and therefore I don't want to isolate Canfin from the industry. But having said that, I think we have a very strong mechanism. We have a very strong underwriting team. We have a very stringent selection process, and we manage our customers well. We know our customers very well. Now, having said that, see, whenever there is increase in interest rates, so the affordability will come down for the new customers, and for the old customers, I think the EMI burden goes up if there is no scope to increase tenure, and therefore the risk of default will increase. And that is why they say when the interest rate goes up, default will increase. Or when the price of the apartment goes up, affordability, to that extent comes down, and therefore it could have an impact if people stretch and go in for a larger size apartments. That's the reason. So what we do is we take care of these two things in our assessment process, and to that extent, our risk is lower. Otherwise, generally speaking, when the interest rate goes up drastically, default rate will increase. For Canfin, if you look at last 8-10 quarters, asset quality has been very good. NPA has been pretty stable in spite of COVID, in spite of moratorium, in spite of restructuring, 1 and 2 resolution. I think our NPA has been pretty stable. That's only because, we take care of all these things. All these things are inbuilt in our assessment model.
The thing about Canfin also, Mr. Kousgi, is the point that you've had, you could argue, except for certain instances, near consistent performance. Now, my question to you is, because bases are higher, because economic growth scenarios are different world over and in India, what's your sense of confidence about how consistently can you grow, and what's the nature of that consistent growth going to be going ahead? I don't mean just the next 3 quarters. I mean, arguably the next 3 years.
I'm saying for next 5 years, Canfin can grow at about 18%.
Okay, with similar performances on asset quality.
Yeah, there could be slight difference, maybe plus or minus 10 bips here and there. Otherwise, I think asset quality is going to be very good. GNPA will be pretty stable. So now we're at 0.65%. I think the worst could be about maybe add another 10 or 15 bits, maybe up to 0.8, whatever I'm just saying on the extreme side. So asset quality will be pretty stable.
Okay,
because
please continue.
Because we have seen this both in good times and bad times. Even in bad times, our asset quality was pretty good. Our NPA went up to 0.99%, and this happened during COVID, immediately after COVID, and that too because this is based on deemed NPA, because we had to we got dispensation from RBI because of COVID. Had we not got the dispensation, our NPA would have been 0.99%, so which is deemed NPA. So from 0.99%, now again we are back to 0.65. because now it's a reality. Then it was notional. Now it is reality, because all those customers who opted for that benefit are now paying, and therefore now it's a reality, and now it's back to 0.65. So our NPA would be about, max could be about 0.8. That's all, about 15 bips higher than what it is currently. So it will be pretty stable, in the years to come.
And cost of funds moving up will not have a material impact, you reckon?
See, cost of funds is definitely not in any one company's control. We can try to optimize cost. We can, we can work around as to how we can bring down cost. But at the same time, what is in our hand is to try and manage the yield so that we get the right margins. So cost will go up. So we will definitely, try to build book at a certain yield, which can give us the requisite profit.
Okay. Mr. Kousgi, just one final question. Any kind of any near term, medium, or any near term in the current fiscal, any kind of fundraising activity that you envisage you would go ahead with?
Yeah, I think we are planning to raise capital. That might happen in next 3 to 4 quarters. Not very, very particular, but we will raise some capital. We have enabling approval of 1,000 crores from our shareholders. So part of that amount will raise.
But not necessarily in Q2 or Q3. It could happen maybe in the second.
Yeah, it can happen in less than 4 quarters.
Less than 4 quarters means this month as well, and maybe 6 months down the line as well. Just trying to understand, is there an immediate need, or will it happen with a bit
there
of a lag?
there is no immediate need at all.
Okay, so may happen with a bit of a lag.
Yeah, definitely yes, because our CAR is about 24. We are pretty comfortable, and our DR is under 8. So to just bring down the DR, we plan to raise capital, and therefore there is no immediate need. This will be growth capital, and therefore we are not in a hurry.
Okay. So 18% growth for the next few years, 50% PAT growth in Q1, and good show might continue in the next 3 quarters. FY23 much better than FY22, with stable NIMs and stable gross NPAs. Thanks for that commentary, Mr. Kousgi, and all the best for the quarters ahead.
Thank you so much.
And viewers, thanks for tuning into this edition of The Talking Point.